Hello everyone, welcome to this presentation on business responsibility and sustainability reporting, commonly known as the BRSR Framework. I am NVS Pawan and I am a chartered accountant. This presentation is a part of the deep dive series into the BRSR Framework. To understand the fundamentals of the framework, I would recommend you to watch my previous video, the BRSR Overview. In the last video, we had discussed section A of the framework, which gave us a context of the nature and scale of operations of the entity. In this video, we will look at the disclosures under section B of the framework. Please note that the discussion here is not in the same order in which they are present in the framework. Before we take a look at section B, let us briefly revisit the fundamental concept of double materiality. Materiality in the context of sustainability is defined as the most significant impacts. It is of two types, financial and impact materiality. Impact materiality is the most significant impacts which an organization has on the environment and society due to its direct operations or indirectly through its value chain. Financial materiality, on the other hand, is the most significant impacts of the sustainability factors, that is the environment, society and other stakeholders, on the business operations and thus have financial implications. From the entity's point of view, you can visualize financial materiality as inward looking and impact materiality as outward looking. We had seen the disclosures of financial materiality, that is the impact on business operations due to environment, people, etc. in section A of the framework. Section B and section C of the framework deal with impact materiality, that is environmental, social and other impacts of the business operations. What is the significance of section B of the framework? This section paints a picture of the readiness of the entity's top management to embrace sustainability in its operations. Just like any other business strategy, the strategic path of the sustainability maturity starts at the top. If the tone of the top management is set, it creates the mood in the middle management, which in turn starts the buzz at the bottom. The first level in the strategic path is the awareness of the most significant impacts of the business operations on the environment, social and governance aspects. Typically, this step needs to be done by identifying the stakeholders and engaging with them to understand their interests in the entity's operations. However, BRSR framework makes it easy for the entities. It gives them a ready-made list of significant impacts, also known as material topics, to be reported. The second level is crucial, where the board of directors need to display an intent and commitment to all the responsible business conduct principles. This has to be done by developing policies on various aspects of the operations. Also, a governance framework needs to be set around sustainability, meaning a committee or a person need to be identified to oversee the management of its material topics. The third level is the most difficult level, that is implementation of the policies by making procedures out of them. In this step, the entity develops user manuals, imparts training to its personnel, starts managing data with respect to sustainability KPIs, and also seeks external validations through national and international certifications. When the entity is confident of its sustainability performance, it may start setting targets in the fourth level. It will first identify a baseline, that is, the earliest relevant point in time for which the entity has a reliable set of data available. It will start monitoring the data thereon to ensure that it is on track to meet its target. The target will have expected outcomes with expected timelines. Examples of target setting are water neutrality by 2030 or net zero emissions by 2045, etc. Level 5 of maturity is when the entity has achieved such a level of maturity that it can go for an independent external assessment and apply for international ratings for its sustainable operations and governance oversight. In this stage, the entity also uses its leverage to get its value chain partners fall in line and start their sustainability journey. Section B has disclosures on all the above levels. It presents a roadmap and effectively nudges the entities to go to the next level of maturity. We will observe this in the subsequent slides. The first disclosure in Section B is whether policies are present on each of the 9 NGRBC principles. One clarity which is needed here is that the entity does not need 9 policies for the 9 principles. It needs to have policies on various aspects of its business which need to be linked or mapped to the 9 NGRBC principles. For example, a policy on customer data privacy can be linked to Principle 9, that is, serving customers responsibly. A code of conduct for board of directors can be mapped with Principle 1, that is, conducting business with ethics and integrity. Generally, large entities will have close to 25 policies in total to cover all the 9 principles. Let us take an example of Asian Paints Limited. We can see here that there are a set of 5 to 10 policies mapped with each NGRBC principle. As we had discussed earlier, the principles are closely interrelated. So, any policy will have an element which caters to multiple principles. For example, the environmental policy of Asian Paints Limited has such elements which makes it mappable to principle number 2 on sustainable products, principle number 3 on health and safety of employees, and also principle number 6 on protection and restoration of environment. Entities need to give a web link of all the policies. Now, if the entity does not have the requisite policies against any principle, it will be subject to some probing. Does the entity not consider the principles material to its business? Why is it not able to formulate and implement a policy? Is it not in that stage, or does it not have the financial, human, or technical resources to do so? Will it be done in the next year? Clearly, this intense questioning is indeed to nudge the entity to start getting its act together and start taking sustainability reporting on priority. The next disclosure is that if the policies indeed are present, has the entity taken the next step and converted them into procedures? Have the procedures been implemented, and is the performance being tracked by somebody? If so, then how frequently is the performance being tracked? Next, is the entity leveraging its position to influence its value chain partners to develop similar policies? This, as we had discussed, is the highest level of maturity in sustainability reporting. Next, the entities need to disclose the details of the highest authority responsible for the implementation of the policies. This can be done by a single director or a KMP This can also be done by one or more committees of directors like the CSR committee, the risk management committee. A committee of employees is also allowed to be responsible for the implementation of the policies. But then the next question asked is a specified committee of directors identified for decision making on sustainability related issues? This is clearly a strong signal that nothing less than a board level committee or a director should be involved in the sustainability related matters. This is further augmented by this requirement of a statement from the director who is responsible on the sustainability related matters. In this statement, the director needs to explain the overall strategy of the entity to manage its impacts in the short term, medium term, and the long term. He or she needs to elaborate on the specific challenges faced by the entity in its sustainability priorities. They may also elaborate the key events or achievements and failures during the reporting period in the statement. The next disclosure is about the national and international certifications earned by the entity. Some of the international certifications with respect to products and processes may be the FSC certificate for managing forests responsibly, the ISO standards. Some of the Indian standards for products include Trustee certificate for sustainable practices across the supply chain in tea industry. AgMark is a standard for agricultural products, and the certification by Bureau of Indian Standards for safety is applicable to almost all the products and services. Here is an example of the standards and certifications earned by Asian Paints Limited. We can see here ISO standards on quality, operational hazards, environmental management systems. Asian Paints also reports under the Global Reporting Initiative, the GRI, which is the sustainability standards used by most of the entities worldwide. Asian Paints also reports under the TCFD framework. All these certifications have been mapped to the NGBRC principles. So what these certifications essentially signify is that the products and operations of the entities are subject to external evaluation periodically and that they are meeting the required norms as required by the principles. One of the disclosures is about the specific targets and commitments by the entity with defined timelines. It also needs to disclose its performance against the specific targets in the reporting period. These targets may be in terms of absolute values, intensity, or also in terms of percentage. An example will be the best way to understand this. We will again take the example of Asian Paints Limited. It has committed itself to become powered by 100% renewable energy by the end of 29-30 financial year. It has reached 66% of its target by 23-24 financial year and has targeted 75% conversion into renewable energy by the end of next year, that is 24-25. Similarly, it wants to achieve 75% reduction in non-process water consumption intensity before 29-30 financial year. With respect to emissions, it has taken an absolute target of reducing emissions by 49,000 tons of carbon dioxide equivalent by 2030. Apparently, it has already met this target in financial year 23-24 itself. Another emission related intensity target with respect to production is to reduce the intensity from the baseline of 131.2 in financial year 13-14 to 26.2 in financial year 29-30. That is a significant reduction. Baseline, as we had discussed earlier, is the earliest relevant point in time for which the entity has a reliable set of data available. Targets are set by the entities with respect to baselines. Companies also need to disclose any lapses in any of the statutory requirements which has relevance to any of the NGBRC principles. For example, non-payment of statutory dues on behalf of the employees affects principle number 2, that is employee well-being. Another example could be a lapse in the management of board affairs, which is maybe pointed out by the regulator. It is relevant to principle number 1, which is ethics and governance. The last disclosure, here the entity needs to disclose if the working of the policies has been evaluated by an independent practitioner. This is an ultimate assurance for any stakeholder about the sustainability practices by the entity. It may be possible that the working of only certain policies may have undergone external evaluation. So that's about the disclosures in section B. To summarize, this section helps the stakeholders to get a sense of the extent to which the sensitivity with respect to sustainability has percolated in the top management of the company. This also shows the entity a mirror on the extent to which it is ready to manage the impacts it has on the environment and society. In the next video, we will discuss section C, which has 107 KPIs under the 9 principles. These KPIs disclose the specific impacts of the entity's operations on the environment and society. Thank you. Bye-bye.